Welcome to the week that was, TIOL's weekly news roundup. Today we bring you news on the implications of net neutrality, debt recovery for banks, moves to curb tax evasion, tax collections, and judicial statistics.
There are also stories on efforts to reduce pendency, action against dodgy bureaucrats, and possibly a windfall gain for PF subscribers. But first, let's move on to net neutrality.
After months of deliberations, the Telecom Regulatory Authority of India has finally upheld net neutrality and ruled against the telecom companies. In favor of transparency, it has given a thumbs down to differential pricing for internet services, which would have allowed internet giants like Facebook and Airtel to divide the internet into free zones and the paid service areas. Stripping Facebook's aggressive ad campaign of the jargon, the authority has ruled that free basics and differential pricing cannot help to reduce the digital divide. The authority has prohibited telecom service providers with immediate effect from offering differential tariffs based on content service or data being accessed or transmitted by the user on the internet. Any violation of these rules would attract a harsh fine of Rs 50,000 for each day of contravention, but which is capped at Rs 50 lakh. However, provision of limited free data that enables users to access the entire net is not prohibited. Service providers may also allow the data plans in emergency situations such as floods and earthquakes. Hence, service providers eager to connect the unconnected are welcome to do so without resorting to differential pricing. Differential pricing of free basics or zero rating platforms developed in partnership with the internet service providers provide customers free access to certain applications, but every click out of that free app may be chargeable at a differential price. Even Airtel had launched Airtel Zero last year in April, but withdrew it after criticism. While this order favors net neutrality, clarity is still needed on the differential controls over internet speed and internet traffic management. Is the recovery of debt more important than the revival of a unit? Let's find out.
Concerned over the staggering debts outstanding in the financial system, the Supreme Court has ruled that debt recovery from a sick unit must take precedence over any attempt to revive it. This decision will make it easier for the secured creditors of a sick company to sell the assets of the sick unit to recover their dues. When the claims by the secured creditors of a sick unit exceed 75% of the outstanding debt and at least 60% of the secured creditors decide to recover their dues, all revival proceedings have to abate. The decision delivered by Justice Kurian Joseph and R.F. Nariman clarified that the secured creditors of a sick unit do not need permission of the BIFR at any stage. Under the Sick Industrial Company Special Provisions Act, they can take possession of the assets and even the management and sell off the assets to recover their dues. This exception is provided by law for the company's secured creditors. The unsecured creditors at present have to await the result of any revival attempt before they may claim their dues. However, if at least 60% of the secured creditors do not agree to exercise their right under the Securitization Act, then the SICA will continue to operate, the Apex Decision Court stated. In a connected development, major corporate houses with huge debt have started repaying their bank loans.
The free ride is over. Concerned with the bad loan crisis and huge non-performing assets of public sector banks, the government has informally directed big corporate houses to start repaying their bank loans. Corporate houses have to start payments over the next 2 months, even if they have to sell off their non-core businesses. The top 10 corporate houses include SR, Reliance, Adani, GMR, JP, Videocon and Vedanta, which have combined borrowings of more than Rs 7 lakh crore as per a Credit Suisse report in October 2015. Loans by small and medium enterprises constitutes the bulk of banks' non-performing assets. The government is closely tracking the progress in loan recovery by the banks. SEBI is set to block any attempt at tax evasion.
The end of a financial year usually sees an increase in attempts to evade tax as assessee post bogus losses in stock trades or make temporary mutual fund investments or even through arbitrage in derivatives trading. But now the Securities and Exchange Board of India has increased its vigil over such transactions intended to evade tax. It is also investigating certain cases of tax evasion by way of arbitrage between bogus losses shown in the Indian market and gains at offshore locations. It is even looking into some high-profile cases following the typical modus operandi involving the misuse of mutual fund platforms, besides even looking into manipulations through client code modification where brokers change client details in sale and purchase orders of securities after the trades are conducted. As such manipulations increases around March end, the financial regulator is on its guard. Issue of tax refunds have been speeded up.
The CBDT has speeded up the issue of tax refunds. Up to January end, the board had issued tax refunds of Rs 1 lakh crore to 1.75 crore assessees. This follows the CBDT's recent direction to its officers to expeditiously issue tax refunds less than Rs 50,000 in a bid to reduce taxpayer grievances and promote a tax-friendly administration. Will the government retain the tax incentives for special economic zones?
The Commerce Ministry has requested the Finance Ministry not to invoke the sunset clause for special economic zones as it would hurt India's exports and employment generation. In its budget recommendation, the Commerce Ministry suggested that abolition of tax incentives would impact the large investments made in these special export zones. It has also asked for removal of the minimum alternate tax of 18.5% on cess book profits for 5 years. These recommendations are in response to the CBDT's proposal to remove facilities and tax incentives for special economic zones by March 2017. Will government allow 100% FDI in e-commerce retail? Let's find out.
The government may soon give a green signal for 100% foreign direct investment in e-commerce companies. The Finance Ministry is considering the proposal by the Department of Industrial Policy and Promotion. Although at present no FDI is permitted in e-commerce, most of the major online players like Flipkart, Amazon and Snapdeal have attracted funds by international investors and managed to skirt this rule. About 21 e-commerce companies are being investigated for possible violation of FDI rules. If this proposal for 100% FDI is cleared, will the government be seen to be falling in line with market demand, or would this be a signal that trade and not manufacturing is more valued? The plan to digitize judicial data has failed to take off.
The government's national data grid for judicial statistics has received a setback. The majority of high courts have not complied with the law minister's request to list court performance in terms of pendency of cases or disposal rates on their websites. Only 8 high courts have responded to this request made 6 months ago in July last year at the meeting of the National Mission for Justice, E-Delivery and Legal Reforms. These include the High Courts of Delhi, Himachal Pradesh, J&K, Jharkhand, Kerala, Madras, Sikkim and Tripura. The availability of accurate digitized data is a prerequisite for policy making. Hence, the government wanted each high court to record detailed judicial information including age and category-wise pendency of cases, the average number of adjournments granted in civil and criminal cases, and case trials held up on account of stay orders granted by superior courts. Higher indirect tax collection will offset the shortfall from direct tax.
While direct tax collections are expected to fall short of the budget target, higher indirect tax collections may offset this shortfall and help the government in meeting its targets for 2015-16. For the first 10 months of the current financial year, the total tax collection stood at Rs 10.6 lakh crore, which is only about 73% of the budget estimates and expected to fall short of the budgeted target. However, while direct tax collection up to January 2016 went up by 10.9% to 5.2 lakh crore rupees, it may well fall short of the budget target by rupees 8 lakh crore. Indirect tax collections, on the other hand, at rupees 5.4 lakh have already grown by 33% and are expected to exceed the budget target by rupees 6.5 crore. The job of a vigilance officer may be thankless, but the bureaucrats who do not take up this post are in trouble now.
The Modi government, in its bid to tame the bureaucracy, has taken tough action against bureaucrats who have failed to take charge of their posting as chief vigilance officers in central public sector units. In the last 9 months, the Department of Personnel and Training has taken action against at least 3 officers, one each from the IPS, IRS and IFS, who failed to join as the central vigilance officers for months after their appointment. The department cancelled the officers' appointments and debarred them from consideration for central deputation or foreign training or from being given cadre clearance for being deputed on foreign assignments for a period of 5 years from the date of the appointment. Will this bring the bureaucracy to heel? The EPFO may issue one-time bonus for its subscribers.
Subscribers to the Employees Provident Fund Organization or EPFO are in for a windfall. For the first time, the EPFO may either issue a one-time bonus for its subscribers for 2015-16 or raise the interest rate, resulting in healthy returns on retirement funds. The Finance Ministry may not favor an increase in the rate of interest as it would pressure it to increase interest rates on small saving schemes and would not be sustainable in the long run. Hence, the EPFO is considering a one-time bonus involving a payout of rupees 750 crore for those subscribers who have contributed for 12 consecutive months. This would benefit nearly half the EPFO subscribers, most of whom are in the low income bracket and otherwise would not be entitled for an income tax exemption for their deductions under Provident Fund. A final decision is expected to be taken next week. A former MLC from UP is under investigation for money laundering.
The government is investigating charges of money laundering against a former member of the Legislative Council in Uttar Pradesh. The Serious Fraud Investigation Office, the Enforcement Directorate and the Income Tax Department are each separately investigating the charges that this MLC floated 111 shell companies in India and overseas with nominal capital which amassed wealth and were used to launder more than 10,000 crore in black money. This case is being heard in the Supreme Court following a public interest litigation accusing the MLC of violating foreign exchange management laws and amassing black money. The Enforcement Directorate has found evidence linking the MLC with the National Rural Health Mission scam in UP. The MLC maintained that these charges have been fabricated by his political rivals and even the complainant is involved in illegal sand mining. The Supreme Court has sought a report on the investigation by April end. Jewelry shops across India remain shut in protest against the PAN card rule.
Jewellery shops have not taken easily to the government's mandate for customers to provide PAN card details for transactions above rupees 2 lakh. Most jewellery shops and jewellery traders across the nation remained closed on Wednesday this week, which was part of an India-wide bandh called by the All India Jewellers Association and state jewellery associations. The jewellery sector fears that making submission of PAN card details compulsory will kill the retail sector and result in a loss of business as more than 90% of customers do not have a PAN card. So either these customers of small and medium jewellery showrooms would be harassed or the businessmen shall be tempted to trade in an unscrupulous manner by encouraging unbilled transactions, causing a loss to the government. The Jewellery Association, while not opposed to this rule, believes that it should be implemented only after all salaried and business persons have obtained a PAN card. Or sale transactions must be made cashless. Until then, the earlier limits of Rs 5 lakh for gems and jewellery and Rs 2 lakh for bullion must prevail.
On this note, we conclude this bulletin of the week that was. Thank you for watching.
You may write to us at editor@tiol.in. Have a wonderful weekend ahead.